Did you know that just by watching the videos on this channel, you are making the world a better place? That's right. Every video you watch helps bring high-speed internet connectivity to remote communities around the world that are in need. Every view, like, comment, and share counts towards making our goal of worldwide internet connectivity a reality. So please join us in our mission to connect the world by sharing our content and becoming a subscriber today, because together we can make the world a better place. Hey everyone, welcome to my market commentary for the fourth quarter of 2022. We will be updating our views on the markets, yield curve, savings rates, but really as an investor, 2022 will go down as a year to forget. Let's jump in. Hi, I'm Joe Macek, Portfolio Manager and Investment Advisor for IA Private Wealth, helping guide and counsel investors for over 23 years. In this final quarter of 2022, the Fed continued to be consistent with its very hawkish interest rate approach to get inflation under control. The markets continued to decline with several bear market rallies having materialized. The 10-year minus the 3-month yield curve has not only officially inverted, but has seen one of the deepest inversions I have ever seen in my career. And we update you on the current Fed balance sheet, current savings rates vis-a-vis cash balances of consumers, and take all of this and try to put together a forecast for the next 12 to 18 months. But as always, before we get too deep into the video, I'd like to go through my usual disclaimer. And if you have any questions surrounding your investments, feel free to reach out to me on a one-on-one basis, as my contact details are now provided in the description below. Well, 2022 was a year to forget if you were an investor, as the general markets were down quite considerably. The S&P TSX Composite Index was down 8.5%. The Dow Jones was similar to the TSX, down 8.8% for the year. The S&P 500 was down a whopping 19.4%, and the tech-heavy Nasdaq was down 33.1% for the year. Now, towards the end of 2021, my forecast for 2022 returns in the markets were somewhat positive, as the Fed made it pretty clear that they were going to gradually raise rates and refrain from rolling off the balance sheet at the same time. However, my views and forecasts changed just as quickly as the Fed did in the first quarter, when they completely changed course on that line of thinking and proceeded to start to raise rates and roll off the balance sheet at the fastest pace in recent memory. And once again, as in the previous tightening cycle, this caused a very normal yield curve to begin the inversion process exceptionally fast, as this is a process that normally takes years and it only took a matter of months to happen. And by the time October 2022 rolled around, the 10-year minus the 3-month was officially inverted. Now, for those of you whom are new to the channel and are unfamiliar with how the yield curve and its predictive power work, almost all of the market commentaries I do focus on the shape of the yield curve. Please feel free to check out This is the Ultimate Indicator of Collapse, and that video goes into the yield curve in detail as to how and why it is so important. So make sure to check it out if you haven't already. Link in the description below. The Fed early in 2022 switched gears and was steadfast in telling the markets that it would not deviate from hiking rates until inflation was under control. And the Fed, true to its word, raised rates the most the markets have seen since the hiking in 2005 and 2006. We essentially went from 0 to 4.25% to 4.5% in 9 months, as you can see here in this table. And at the end of 2022 and going into the beginning of 23, the Fed remains exceptionally hawkish and has yet again confirmed that they will do whatever is necessary to crush inflation. This has led to a yield curve that has inverted the fastest I have seen in my career. The spread on the 10-year minus the 3-month has gone from a high in May of 227 basis points to a low of minus 142 basis points by March 30th. A truly incredible move in the bond market, to say the least. The yield curve has had a deep inversion for 5.5 months now, with seemingly no change in sight. And the longer this remains, the higher the probability for recession becomes. And while we started to become defensive in the first quarter of last year in our portfolios, this massive move in the yield curve has put our office officially on recession watch from October 18th, 2022 for a period of 24 months to October 18th, 2024, or a substantial market decline, whichever happens first. The Fed balance sheet has also continued to roll off until late March, when some of the regional banks got into trouble. As you can see here, the SVB and Signature crisis quickly unwound any balance sheet roll-off the Fed was doing, and we are now back to just over 8.7 trillion from just over 8.3 trillion. It seems as though the shadow hiking is on pause for now. The savings rate in the US continues to be under 5%, a red flag when it comes to consumption. As we all know, consumption from the US consumer is a major driver for the economy in the US. Personal consumption as a percentage of GDP remains close to 70%, a number that has been consistent since 2001. But as we can see in the next few articles, the consumer is starting to feel the effects, as now more Americans are falling behind on their car payments than during the financial crisis. In December, the percentage of subprime auto borrowers who were at least 60 days late on their bills rose to 5.67%, up from a 7-year low of 2.58% in April of 2021, according to Fitch Ratings. That compares to 5.04% in January of 2009, the peak during the Great Recession. And the death of easy money has sparked a decline in the US housing market, as it has already begun to deteriorate after mortgage rates doubled last year, with new home sales declining from a peak of more than 1 million a month in August 2020 to 640,000 in November of 2022, and monthly existing home sales decreasing by a third. The pain may just be starting for housing, with home prices expected to post a full-year drop in 2023 for the first time in more than a decade. And it seems the delinquencies in credit cards are rising as well, as more US consumers are relying on their credit cards each month. Around 46% of cardholders don't pay off their credit cards in full each month, according to data collected by Bankrate LLC in December, up from 39% a year earlier. All of this would seem to fit with our next chart, which shows checkable deposits seeing a slight downtick in the fourth quarter. And when we start to look at the overall picture, all of this points to an increasingly stretched consumer, which does not bode well for the economy and markets in general going forward. If that weren't enough, the consumer isn't really getting any help on their deposits either, as average CD rates on deposits for the final quarter have risen slightly, but are nowhere near the Fed funds rate, which indicates banks are still in no need to compete for capital for loans. We started following this metric in the second quarter commentary to see how this would impact lending, and we will continue to monitor it into the new year. Given the headwinds of rising rates and persistent inflation, our forecast remains absolutely unchanged from the last quarter. Assuming the Fed maintains its hawkish stance and continues to hike rates despite stubborn inflation, the US economy will experience a recession and slow down materially. Cash balances and consumers' deposits will eventually start to dry up in 2023, and we suspect that as that happens, the banks will be forced to increase their savings rate payouts and compete for capital for lending. Lending will eventually become more difficult to do profitably for the banks, and we suspect that in the latter half of 2023, should the Fed not pivot, we anticipate a recession to fully materialize. If we are correct that a recession materializes into late 2023, the Fed may actually reverse course and start cutting rates into late 2023 or even into early 2024. In the short term, we expect the markets to continue their downward trend in the first half of 2023, given the challenges they face. However, there are numerous moving parts that could impact our outlook, and we will need to observe how things develop. As an investor, if you are younger and you have many years to retirement, you may find the next 12 to 18 months to be an exciting time. You likely have little in the way of invested capital, and it is probable that you will see a lot of red days and sales in the markets in the next few months. If you happen to take advantage of the dips over the last quarter, continue to do so and focus more on the buying opportunities rather than on your short-term performance. You are likely to see a lot of great deals on a lot of excellent companies. Consistently buy on red days and dips, even though there may be more sell-offs and deeper dips on the horizon. It may be challenging to see fresh money go into the market time and time again, only to see it decline. But in the long term, you will likely be happy you added as much money as you did during a bear market. If you are close to retirement or in the early stages of retirement, this could be a tougher time to get through mentally and emotionally. You probably have a considerable amount invested and are not currently working to replenish any principal affected. If you haven't already, you may want to prioritize preserving your capital at this time. If you have reduced equity exposure over the last few quarters, continue to do so into any rallies the markets give you and reassess your portfolio. If there are any volatile or high-risk positions remaining in your portfolio, portfolio, consider reducing them and purchasing alternatives that have a strong track record during tough times. For our clients, we have performed exceptionally well during this latest downturn, and we have taken several opportunities last year to sell into rallies and preserve our capital in our discretionary portfolios. We've also added additional names to our private equity sleeves, which will hopefully reduce volatility and provide better risk-adjusted returns. Well, that's it for this quarter, and once again, I want to thank you for joining me here today. Until next time, this is Joe Macek for Investing Made Simple. See you soon.